All right, let's do some more work here in section 4C. And keep in mind that I'm going to give you all these formulas. You just need to know when to use them and how to use them. So we've got a couple situations here. We might want to find total and annual return. Here is the deal. It's usually not the case that the interest that you earn is always constant. It actually fluctuates over time. But when you have this fluctuation, you might be interested in knowing, well, over the long run, what was my total return? Or if I kind of average that out, what was my annual return? Got two formulas to work with. Total return is the relative change in an investment value, and it's going to be a percentage. And it's looking at the value of A, which is the amount in the account after so many years, and the value of P, which is the principal amount that was invested. This is just that old formula that we saw earlier in Chapter 3 when we worked with percentages. It's that new value minus the old value divided by the old value. And we multiply it by 100% to get a percentage. So the new value is the resulting balance. The old value is the principal divided by the principal. Okay? Annual return takes that amount A, the amount that's in the account, that final balance, divides it by P, the principal amount that was invested. That amount is raised to the 1 divided by Y power. Then that whole amount, we take it and subtract 1. So those two formulas are also given right here. Total return, A minus P over P times 100%. And annual return is A divided by P, all raised to the 1 over Y power. Then we subtract 1. And Y is just the number of years that that money was left in the account. Okay, so let's just do a couple of examples. Let's find total and annual return. The first one is you invest $3,000 in a Clearwater mutual fund. Over 4 years, your investment grows to a value of $8,400. Find the total and annual returns for this 4-year period. So from the formula, the total return is basically the new value minus the old divided by the old times 100%. And the new value is the $8,400. The old value is the $3,000. That's the part you invested, divided by $3,000. And then just multiply that by 100%, and this will tell you in total you earned this percentage. Your investment increased by this percent. So find that number. You'll find that your investment increased by 180%. So that means it more than doubled. It went from $3,000 to $8,400. So an increase of 180%. That was your total return on that investment. The annual return, if we look at the formula, is A, which is the new value, $8,400, divided by P, your principal investment, raised to the 1 divided by Y. So that would be raised to the 1/4 power. Then we subtract 1. Determine your annual return. Annual return, again, is given as a percentage. So when you make the calculation here, you should get 0.2935. And if I multiply that by 100%, that's 29.35%. So on an annual rate, my investment earned about 29%. Okay, do the same thing with that next problem, and then check your work. So if you use the two formulas to find the total and the annual returns, you should see a loss here. The total return is minus 45%, so that represents a total loss of 45%. And the annual return is a negative 18.06%, and we interpret that as a loss of 18% annually. So let's look at some other investments, different types of investments there are. We've seen the cash investments. You put into a bank account, certificate of deposits, maybe U.S. Treasury bills. Those cash investments usually earn interest. But we haven't talked about stocks or bonds. These are some other investments, and stocks basically give you a share of ownership in a company. The only way to get your money out of that is to sell the stock. And because it changes with time, the sale may give you either a gain or a loss. Bonds represents a promise of future cash. You buy a bond that pays some principal amount to the government or corporation, and the issuer pays you simple interest, not compound interest, and promises to pay back your principal plus that interest at some later date. So these are some types of investments, but there are others. So let's list a few others that aren't listed here. We might think of mutual funds. That's kind of in the stock market realm. Someone could invest in real estate. You might invest in a business. So there are different ways to invest your money. Some things you want to keep in mind as you're investing would be liquidity. How difficult is it to take out your money? If you need money fast, then you want to make sure that your investment is liquid. The risk, is your investment safe? And the return, how much return can you expect on your investment? So of the ones that we've mentioned above, how difficult would it be to take out your money of, let's say, a bank account? Very easy. It's really liquid. Just go in and get your money out. So those cash investments are pretty liquid. Stocks are pretty liquid. Just have to sell your stock and get your money out of it. Real estate, and maybe if you invest in a business, it's not so easy to get your money out of those. Okay, now risk. How safe is your investment? Well, if your cash is in a bank account, it's safe because it's federally insured. So little risk in cash, but you also have very small returns. Let's see. Stock. Stock is risky. You may have a gain or a loss with stock, so there's some risk involved in that. Real estate, risky. You might not be able to sell it for a higher price than what you paid. Business might fold, so that could be pretty risky. And the other consideration is return. How much of a return can you expect on your investment? Cash investments, the bank will state what that return is, usually not very high. And stocks, it just sort of depends. Stocks depend on the market. So here are some investment principles. Always do as much research as you can. Learn about investments, read books, financial pages of newspapers, online. Just do your research. Higher returns will usually involve higher risks. Makes sense. Low risk have relatively low returns. You've got to watch out for commissions and fees that can lower your returns. And you want to have a portfolio that's diversified, that it balances risk and return in a way that's appropriate for your situation. So there's really no way to predict what will happen in the future, so sometimes we'll rely on historical trends to help guide us in how we should make our investments. Over the long term, stocks have proven to be the far better investment than bonds or cash, just from a historical perspective. and in the long run. I love this graph that shows the Dow Jones Industrial Average over a period of years from 1900 to 2000, 10, 11, 12, probably 2013. So looking at the trends in the stock market over a long period of time, what do you notice about this graph? If you were to sort of look at point A here at the beginning and point B here at the end, and you drew a line between those two, then you would notice that historically stocks have gone up. They have risen. But when you look at it in the short run may seem long term, like 25 years or so, there could be some issues. And I mention that because of the stock market crash. Can you picture or point out exactly in this graph where that occurred? Even if I didn't have the dates on the bottom, you probably see this really big jump in the graph, and that is right around 1930, maybe 28, 29, 30, up in there. That stock market crash, terrible financial disaster. Here at the beginning, you can see the stock markets were as high as they ever were. And in a very short period of time, maybe 5, 6, 7 years, it crashed to just about the lowest it had ever been. So those folks that had money invested at this high rate, and let's say, their investment was worth millions of dollars, lost an incredible amount of value within those years, from millions to maybe just hundreds or thousands of dollars. Now take a look at, it was a terrible situation. People killing themselves, the Great Depression, just terrible times. Let's take a look at if someone invested their money here at this high in about 1929, somewhere around there. They were at the high, lost all that money. What year or how many years later did it take them to get back up to that high point that they were at? Let's find out what that year is. Gosh, these lines are hard to see. But it looks like maybe around 1955. So we're looking at 1930 to 1955. That was 25 years later when they found themselves back to the point where they were worth that same amount prior to 1930, right before 1930. 25 years, that's an entire career. And you would be planning for your retirement within those 25 years. In that period, in that 5, 4, 3-year period right there, major changes. But then you notice the trend is that stock market went back up, and we still see the same situation. It has a positive slope when you look at it over a long period of time historically. And again, historically, stocks have proven to be get the better return on your investment. So just a little information. Historically, stocks have an average annual return of 6.3%. Bonds have an annual return of 2.0%. And historically, cash has an annual return of about 0.9%. So let's take a look at maybe $100 that was invested in each of these three funds at the end of 1900 Assuming that they all grew at the rates given above, let's find out how much each investment would be worth at the end of 2012. And we're going to assume that interest is compounded once a year. Okay, what happened here? All right, let me erase that and get back to where I was. Here we go. Okay, so end of 1900 all the way to 2012, I need to know how many years is that. So I've got to have that value. And I know I'm investing $100, so there is my principal amount. I've got my APRs here for each of those situations. Interest is compounded once a year. So that means I'm using this formula, that A equal P times 1 plus APR over N to the NY. And I think we have everything that we need to sprinkle in for these three situations and see what that investment would be worth now. So take a second and set those up. You're going to have three situations, one for stocks, one for bonds, and then one for cash. So set that up. So check these values out. Again, we're investing $100, stocks, $100 in bonds, $100 in cash. Stocks earn 0.063, bonds earn 0.02, cash 0.009. We're going to leave that in the account for 112 years. From 1900 to 2012 is 112 years. And if interest is compounded once a year, that means in our formula the value of N is going to be 1. So had we left or invested that money in stocks, we would have obtained $93,697 basically. If that money had invested in bonds, we would have earned $918. And had we invested that in cash, we would have seen $272.77. So that's interesting to look at, what each of those would bring given our historical annual returns. So, in understanding financial data, the best investment would be characterized by which of the following? I've got three parts, A, B, or C. Low risk, high liquidity, high return, that's one scenario. Or high risk, low liquidity, high return. Or part C, low risk, high liquidity, low return. Which one of those would be the best investment? I always want low risk. I always want high liquidity. And would I prefer a high or a low return? Definitely a high return. So A would be the best investment, the characteristics of a best investment. So if someone is about to retire, they should make low risk investments. And some of those low risk investments are cash, CDs, money in the bank. That would be the lower risk investments. Now you can go to my math lab, work on the homework for section 4C. You're also going to have a chapter 4 applications work that's going to look something like what I have here. I'm going to give you a stock market quote. So here's a stock market quote for Cisco. Cisco Systems Incorporated. On the stock market, it's usually a 4-digit name, and for Cisco it's CSCO. Actually, this isn't Dow Jones, it's NASDAQ. Okay, so looking at Cisco, CSCO is the four-letter name. Look at the information they've given you. They give you the last, which is the value it was prior to this printing. What was the last value, or I should say at the end of this printing, what was the price? And you can see here at the end, it was $25. It gives you a change and a percent change. So here the change is 0.46, which means there was a change in 46 cents, and that's a 1.87% change. So the price went up. You get a volume, how many shares were traded, and then it gives you an average volume over a 10-day period. 27.3 million shares were changed on average in a 10-day period. So I looked at September, from September 26th, let me see, 2014, is this? Okay, I printed this on September 26th, pardon me. It's been a minute since I did this. And what this does is it gives you a yearly snapshot from October 2013 to September 2014, gives you a snapshot of how that particular stock behaved over a 1-year period. We've got some highs, we've got some lows, we've got the values that it closed at. In October, it looks like that it was at about, maybe $23.50. Then we see here between November and December a steep decline. Then we see it rising, then a little decline to where we are here at $25. And then right below that you get a little graph, or you get a graph showing the volume over that year, the volume of shares that were traded. And here, kind of almost mid-November, we see a really high volume, higher than 200 million shares. So we can see at what time we had those high volumes of shares being traded. So you'll have an assignment where you'll have to read this and get some information about that particular stock, how it behaved, and answer some questions regarding that. So you'll just be looking for that. I always send an email. Okay, so finally, I hope this took. I am done with 4C. Let me know if you have any questions.